Hello and welcome back to Equity, TechCrunch's flagship podcast about the business of startups. I'm Haya, and today is our Wednesday episode. We're bringing deep dive conversations back to the podcast on Wednesdays, and today we're taking a look at what some are calling the Series A cliff. To give us some context, we'll be talking to Jenny Fielding, co-founder and managing partner at Everywhere Ventures. Jenny, welcome back to the show.
Thanks so much for having me. Excited to be here.
Jenny's been on Equity before, talking about how startups have to double down on quality and how smaller firms can compete with their more established peers and much more. That's not what we're talking about today, however. It's rough out there for startups. And Jenny, you put out a tweet which sparked a whole bunch of debate. What exactly is the Series A cliff?
Yeah, I'm actually calling it the chasm. That's my new word for it. So essentially, it's much harder to raise a Series A right now. The bar has just moved, right? And so I think what founders are feeling is that while back in 2020, 2021, you could get to something like $1 million in ARR and be able to raise a proper Series A from a great Series A fund. There was, a lot of variables on that, what area you're building in, your team background, all those things. But let's just call that general. And fast forward to today where, the goalposts have really moved. And so the tweet was really what I'm kind of seeing, which is the million has now gone up to sometimes 3 million. And let's not just talk about absolute numbers. There's also a growth rate that these investors are looking at. So it's really a tough moment for founders because they may have raised with different expectations. And now all of a sudden the game has changed.
Yeah, awesome. In your tweet, you specifically mentioned 30% month-on-month growth, which is, super aggressive, obviously. I feel like Y Combinator is pushing for 15% week-on-week growth, which is obviously even wilder. But the compound growth in that is, that is crazy amounts of growth. Is that really the bottom end of where you're able to raise?
Well, I think, and many people pointed out in the tweet that if you compound that out a few years, we're talking about billions, right? And so I think what these VCs want to see is in a snapshot, in a cohort, that there is impressive growth.
Right.
Let me walk through a scenario because I think that would be helpful. So oftentimes we'll see founders are getting started and maybe they bootstrap, maybe they do an accelerator, maybe they raise an angel round. They raise a small amount, few $100K, right? That gives them, call it 12 months to build an MVP. Then you have, we'll call it the institutional pre-seed. That's where I come in. And so let's say they raise, another 1.5, and that gives them another 18 months, and that gets them to a small amount of revenue. Now, that small amount of revenue, few $100,000 ARR, it's not enough to raise a Series A. So they go out and they raise a seed. This all sounds reasonable. That gives them, another 18 months, and maybe they can get to 100K MRR. Now, if you take all the time and add it up of what I've just mentioned, right? So you've got kind of angel, accelerator round, the pre-seed and the seed, we're already at 4 years in. And now they're getting to some revenue, let's call it a little over $1 million. Well, you can't raise a Series A on $1 million, as I mentioned. So now we need to raise another round, and we'll call that a seed plus. And so maybe they raise a few million, and that gives them another 18 months. So now we're 5.5 years in to starting the company. And maybe they're at 2 million ARR. And let's say that is enough. Maybe they're at closer to 3. Great. They're still 5.5 years in. So even though the metric would say okay, you're doing 2.5 million, that should be enough for a Series A, some of the VCs are coming back and saying, well, this is a slow growth business. This isn't going to move the needle for me. We're not going to see the type of momentum that we need to see. So all of a sudden, it's not just about absolutes of revenue, but it's about time to get there.
Yeah.
And so in that scenario, which we see in our portfolio all the time, we're talking about over 5 years from inception through to getting a Series A done. So I call that the chasm.
Yeah, no, totally. I get that. Do you see this across every industry, or are there certain verticals that are more challenging than others?
Well, the elephant in the room is maybe that's not all AI companies, although it kind of depends where in the stack you're playing in AI. But yeah, a lot of the trends are lagging indicators, right? So when we see things in the public markets tank, maybe like fintech, all of a sudden it's hard to get a fintech deal done. But the truth is, we're not looking at what an exit opportunity would be today, we're looking at in 10 years.
Mm-hmm.
So like I'm bullish on fintech, why I love to talk to Marianne, because I'm looking at exit opportunities that are going to happen a long time. And do I think that that's where the world is going? The answer for me is yes. So it definitely is industry specific to a certain extent, but I haven't looked at the data. Maybe you have. I feel like this Series A chasm is really happening across industries, even industries that we don't invest in. I've heard that biotech is really challenging right now.
Yeah, I mean, I feel like the numbers back that up, right? I looked at numbers from PitchBook and Crunchbase and DocSend, and seed companies so far this year have raised about $7 billion, which is down $1 billion year on year. And in general, especially at the later stages, is down significantly. So it's really challenging. The numbers from Crunchbase kind of seem to think that this is like an extended adolescence almost, where you have to get to a much more sensible place. And at the same time, this seems to kind of reflect a desire for VCs to get to a place of lower risk, right? And at that point, I'm like, wait, this doesn't seem like venture anymore, right? If all the risk is designed out of the company, like I work with a lot of founders who get very exasperated, and the general battle cry is like, okay, well, VCs are cowards at the moment for not backing actual risky companies. Does that ring true for you at all?
Yeah, I think to understand the landscape, we have to take a step back and kind of understand how Series A funds operate. And the reality is that they raised larger and larger funds during 2020 to 2022.
Mm-hmm.
And now they're kind of thinking to themselves or scratching their heads, how are we going to return all of that capital when the exit multiples that we thought maybe have come down, right? So if we thought that our companies could exit, a fintech company could exit at 10 billion, and now we've come back to reality because things have been repriced, the public markets have spoken, maybe that company can exit at 3 billion. All of a sudden, our model is a little bit out of sync, right? Couple that with the fact that there's just no liquidity, there's no IPOs. And so the Series A funds are getting a lot of pressure, I think, from their LPs and from kind of the larger ecosystem. But I think fundamentally what it means to be a fund returner when you've raised billions of dollars maybe has shifted with the kind of exit opportunities. So the reality is they're doing less deals. I recently pulled some data just because I was looking for one of our companies to see if it matched what I was reading in Carta and the other ones. And it matched perfectly in terms of number of investments around the Series A. So I looked at Index Ventures, an incredible fund that really have a lot of admiration for them. It's only saying good things, but I looked at their Q2 number of deals for 2022. And so they did about 37 deals. And I think throughout that year, a little bit earlier, it was around the same. Q1 2024, so this year, their total number of deals that they did was 11. And so that's really what we're seeing is that everything has been cut in about a third. And across the stack, money in, number of deals, and that's real. So, I think that contributes to this Series A chasm again. Those numbers don't lie.
No, absolutely. That makes sense. I'm curious. I mean, you mentioned LPs, and as far as I understand, your LPs are different than many of the others. Could you just quickly give us a little bit of context on that?
Yeah. So Everywhere Ventures is backed by a community of founders and operators. And what that means is our LPs are the people that we often invest in. So they're founders and operators themselves.
Mm-hmm.
So they have different challenges, I'd say, than some of the institutions.
Right.
The challenge is when founders are investing in you is often they're running these companies that also are having hard times. And so, that is something that we think about is our LP base and how it's not necessarily diversified. Our founders are in the same boat as our LPs.
Yeah.
So that's something that's unique to us. It really fuels our community because that's where all our deal flow comes from. It's where the support of our large portfolio comes from. We have 250 portfolio companies. So it is really the core of Everywhere Ventures. But at the same time, those folks are also feeling the Series A chasm and beyond. I mean, you talked a little bit about growth. Growth has just been devastated. I had lunch with one of our LPs who's a founder and running a company that's past Series E. And it's just been a struggle. He had to do huge layoffs and just kind of rethink the opportunity for the business.
Yeah. Yeah, thank you for sharing that. I think what I'm seeing across the industry in general from kind of more institutional LPs kind of reflects that, right? I mean, they have so many opportunities to make high-risk investments, and ultimately venture is only one of the opportunities there. And as the risk profile shifts across the entire ecosystem, for them, it's all about the internal rate of return. if you don't have to invest in VC as an asset class, like, why would you? It's so high risk kind of thing. And I'm seeing a lot of the, especially kind of beginner fund managers, but also the more established folks. I mean, the crunch goes all the way up. Like, yes, it's hard to raise for Series A right now, but the VCs are seeing a similar huge amount of like pushback on like, hey, let's see some returns before you deploy more money. And of course, that compounds the whole problem. Does that reflect what you're seeing across the ecosystem?
For sure. And I don't think we've even scratched the surface yet. So I read some article that said hundreds of billions, I think it was like 300 billion are on the sidelines just in venture.
Yeah.
So that's money that's been raised but not deployed. That money was raised 2020 to 2022. So folks are still investing out of those vintages and maybe can stretch them another year or two. We raised our fund in 2022. But when that money dries up, then what happens, right? So if the market hasn't returned, what's really going to happen? So although there's all this money on the sidelines that's still propping up the numbers that we're seeing, in PitchBook and Carta, it could get a lot worse in a few years. So yes, very nervous about that. I think in the emerging manager landscape, it's just getting hard because if you're an institutional investor and you can invest in a blue chip name, taking a chance on an emerging manager, even though the data shows that they outperform, it's just, it's that adage of not getting fired for buying IBM, right?
Yeah.
So even though the data shows it and intellectually that you can outperform with an emerging manager, your emotional response might be, let's just put the money in Andreessen. So I think we're all going to suffer. And I do see colleagues really worried about it and going through longer cycles. And it's tough.
Yeah.
Yeah. As you said, it's just rippling throughout the stack.
Yeah, no, absolutely. You mentioned you were doing a bunch of work with your portfolio right now to kind of figure out how to navigate these choppy seas. What is the advice you're giving? Like, what should you do as a founder once the gravy train stops?
Yeah, I mean, it's interesting. A lot of the advice you're hearing kind of in the macro is you have to control your own destiny and understand what it takes to get to profitability. Now, you're going to run into the same problem I just mentioned with the 5.5 years from inception to Series A if you have a slower growth rate. So I do worry about that advice. But I think that in this environment, you don't have a lot of choices.
Right.
So I think the advice that we're giving founders is a few things. One is understand very clearly what your metrics are. So if you have to get to break even or a profitable state, you know what you need to do to get there. If the money comes and you're able to raise the round, that's amazing. But just know what you need to do and be able to act fast. I'd say that's the second important thing. We saw a lot of hesitancy, and I understand it took you like a year to recruit that amazing person, and now you have to let them go, but you have to act swiftly if you realize that your OpEx is not sustainable. So that's the second piece of advice is know your levers and know how to pull the ripcord if you need to.
Yeah, totally.
So those are kind of the big ones that we're giving. And then the third one, most obvious, is just the founders that are spending time fundraising year round, they just do better. And I know it's a huge distraction, and it's the same advice I can give myself and other emerging managers. You have to spend 10% of your time always getting to know new investors, developing relationships, because that will make the fundraise go more quickly, right? And so it doesn't mean that you need to pitch these people. It just means, you have to be on their radar. We have a founder going out to raise, and, she seemed actually quite confident. She wants to raise $5 million. And she said, oh, yeah, I have 40 people that I've been speaking to since the round that you came in, Jenny, the last round. And I just keep them up to date with updates. I make sure to ping them when I go to a conference. I see that they're there. And so she felt really good because she had 40 relationships. And she never pitched these people. She never made it formal. She didn't, I think some even wanted to preempt her, but she just kept that going. And I can tell you out of 250 companies, it is a very, very small amount that really do that or are able to do it.
Yeah. And so it feels like we've had a big kind of paradigm shift that has happened kind of below the radar, which is going from growth at all cost to like hire slow, fire fast, keep the belts tighten, that kind of thing, and kind of focusing a lot more on operational efficiency. Like it seems like the days of infinite cash are gone. Does that?
But also grow fast.
Right. So grow fast, but don't spend money growing fast kind of thing.
Exactly. Yeah, I think we've entered a new era, and I think people are finally feeling like this isn't a blip. Like we had a great 10, 13-year, run of a bull market, but this is kind of a new normal. And I think, the confluence of things that are happening in the world, the uncertainty about our economy, the election, inflation is down, but it's a little precarious. I think people don't think that it's going to get better anytime soon. We have seen a few bright spots, right? There were a few good IPOs this year already. So, if money is getting returned to LPs in their pocket, that's always a good thing because they can deploy. But 2 or 3 or 4 IPOs is just not enough.
Yeah.
So the whole system is backed up. And I think that is really pushing everyone to this new normal, except if you're in a few verticals, right? So if you're doing infrastructure AI, when you're living in San Francisco, just cover your ears and pretend we never had this conversation.
Yeah, for sure.
Doesn't apply to you.
So you have around $40 million under management and invested in about 250 companies, right? So that's about 160-ish thousand per company on average. You're like at the earliest possible stage of investing in companies. Is that right?
Yeah, that's correct. We call that a pure pre-seed.
Yeah, for sure. Like real venture. Look who I just called out earlier, but here you are doing it.
Well, there was also a funny tweet, some very well-known tier 1 VC was like, I mean, you're not even, really running a VC strategy. You're like a super angel. I was like, okay. I mean, I take money from other people, but I think the point is the names have morphed quite a bit over the years. Yeah. And so maybe with this Series A Chasm, maybe what we're also seeing is that seeds are the new Series A, right? So if you need 4 rounds to get to that Series A, like maybe the terms are just all off.
Yeah, totally. So has this Series A Chasm, the kind of overall macroeconomic risk across the ecosystem, has that affected how you evaluate the startups you are willing to invest in?
We have not slowed down our pace. And so this always shocks people when I give this stat. We invest in almost a company a week. Again, we're pre-seed. We don't anticipate exit opportunities for a decade with these companies. And so we're thinking, where do we feel like the world is going to be in a decade and how are these companies going to get there? Mm-hmm. So we actually have not slowed down. I think what we have come to realize, though, with this cliff or this chasm is that some of the companies might not make it to high growth companies.
Right.
And for our portfolio, which is obviously high volume, that's actually okay. And our model can support it. In our latest fund, we'll have about 80 investments, 85 investments. Because we have such coverage, it's actually okay if a company 3Xs. We need those outliers like every other fund. But because we don't have billions under management, we don't have to be as ownership sensitive. And so if a company kind of decides that they want to become profitable or maybe take a smaller exit, that actually can be impactful for us. And I'll just give you an example. Our fund 1, we had a healthcare company, actually an AI company, which is kind of interesting because we invested in 2018. And it was kind of acquired. Basically, an investor came in and said, like, I want to take everyone off the cap table, and we didn't have much choice. This was $150K check. And this returned a third of our fund because we're such a, our fund 1 was so small.
Yeah.
And so $150K check could actually make a dent in our portfolio. And so that's the strategy that we're operating, which is like quite different than the Series A strategy, which is, 25 bets, deep ownership, and really kind of a different model.
Right. And I guess the other piece of this would be like, what if that founder had held off for longer, right? A third of the fund is great, but what if it could be a full fund returner? Did that bother you at all?
This is actually the end of what I should have said, which is for us, selling for 150 million was very, significant for us. But that would have been a huge failure for any Series A fund, right? If they sold for 150 million, the Series A fund said, like, that's just a drop in the bucket for us to own 20% to return our $1 billion fund. So for a small fund, actually, going back to your question, we don't actually need a whole portfolio of unicorns or outliers. We can actually, these small wins can really eat in to our DPI.
Interesting. And at the same time, you invest in 250 companies, half of them are not going to do great, right? You're in the proper super high risk, super high return business.
Yeah.
And that's a really interesting place to be. I think it's kind of unfair to compare what you're doing with angels because you do have LPs, you do have all that kind of stuff. And the risk reward profile falls. I mean, I'd be very surprised if your investment thesis model look very different from an angel investor, right? Or am I misunderstanding?
Yeah, I mean, when you invest in our fund, you get like incredible diversification across, in this fund, 85 investments. But the way we operate is more like an angel group. So our deal flow comes from this community of 500 founders and operators who are LPs, coupled with our portfolio companies. So call that another 500 if there's two founders.
Mm-hmm.
That's where our deal flow comes. And they help us with our diligence. They help us support our portfolio. So it is a little bit more like an angel portfolio, the way that we operate. And then in terms of our model, I mean, although we're structured as, in a regular fund, in terms of our model and how we can return capital also looks a little bit more angel-like.
Yeah.
We're getting in at low valuation. So we're doing small rounds. Our average round is about 1.5 million, and valuations are, call it, between 6 and 9 million post. So my point is that if you get in at a low valuation, even though it's a small check, your ownership percentage is higher. So that can actually make an impact on your fund.
Yeah, I love that. And so across your portfolio, I mean, 250 companies is a pretty decent sample size, right? How many people are worried about what happens with the next round of funding?
Yeah, so we have 45 companies that are raising right now.
Mm-hmm.
And of that, I would say about 8 are raising Series A. And I would say about 8 of the 8 are in a panic. Really, just because it's just tough. And everyone's telling them it's so tough. And again, if you go back to the index example, they're investing in a third of the number of companies. Everyone is. And so it's just you're competing with your cohort. But the other data point is there's still 300 billion on the sidelines, which means there's still a lot of money going to that early stage. And there's so many pre-seed and seed deals getting done. And now they're competing for a much more limited number of checks from those Series A's. So everyone's worried. And again, we're just telling them, you got to buckle down. You got to know your numbers. You got to focus on growth and efficiency. And you got to understand the ripcord if you do need to cut so that you can live another day.
Yeah.
And I think that's why we're seeing 4 or 5 rounds before the A, because we're seeing these top ups and bridge rounds and plus rounds. And I think I saw the Carta data said about 42% of the rounds were actually bridge rounds at the seed.
Yeah.
They weren't kind of a new round. So we're seeing all that. It's a scary time, but we're founders, so we're optimistic.
Yeah. I mean, look, we're both in the universe of capitalism, right? And I feel like it is always sad when people lose their jobs, and it's always sad when companies fail. But at the same time, I feel like we're kind of back in the OG days of venture, where you're like, hey, you have to really fight for your existence. And if you don't stand out from the masses, you're not going to make it. And on the one hand, I do have empathy. I mean, I've been a founder many times over, and it really sucks when you have to shut down a company. And it's not a bad thing for the ecosystem to have some fresh blood come through, like somebody who fails at one startup. If they're hungry enough, they'll go back and do another one, right? And maybe get it right that time.
Well, it's actually full circle to the tweet, right? Because if you looked at the comments, a lot of the OG VCs who I kind of only know from Twitter or, admired from afar chimed in saying, Jenny, they've always said that. It's always been like this. You know what I mean? They were kind of like, this is old news. It's always hard to raise a Series A. People have been complaining about it forever. So, the data shows it is a little bit harder, but I think their larger point is right? Which is only a certain number of companies can make it through and be outliers. And we've just had such a glut of early stage companies funding excitement about tech, which is a great thing. But, the reality is only a small amount can make it through. And I think, I forget who said this or where it came from, but if you're a Series A or growth stage fund, if you're not in 2 or 3 of the biggest outliers of that cohort, you're not going to have an outperforming fund.
Right.
That's a very different reality than a pre-seed fund, right? So we don't have to have been in Stripe or Canva or one of those just kind of massive outliers to make our numbers look very attractive.
Yeah. Awesome. I think that's a really good place to wrap. I always like to end these interviews on a question what's next, or what should we keep our eyes open for?
That's a good question. We are just doing more of the work that we love to do, investing very actively. So, we want founders to reach out, get connected to us, and be part of our community. And we do a lot of events in lots of cities. If you're coming to New York Tech Week, I think we're doing 7 events. So come find us. We're very happy and approachable. So, that's what's next.
Love it. Well, this whole conversation started with us talking about a tweet, but I haven't actually asked you what your account is yet. How can people follow you?
They can follow me at JE Fielding, and they're sure to get some good hot takes on startups.
Nice. Thank you so much for joining us. I really appreciate talking to you, and good luck with it. It sounds like it's interesting times ahead.
Thanks so much. It was fun.
Thank you so much. Well, we'll be back on Friday, but until then, you can find me on X at Haya, and you can find Equity under the handle EquityPod on X and on Threads. Don't forget to check out our sister show Found, which dives deep into the stories behind the startups with the founders who built them. See you later.
Equity is produced by Teresa Loconsolo with editing by Kel. Bryce Durbin is our illustrator, and we'd like to give a big thanks to our audience development team and Henry Pickavett, who manages TechCrunch audio products. Thanks so much for listening, and we'll talk to you next time.